Welcome to this deep dive. We're talking about a massive, really a seismic shakeup happening in the retail world right now.
Yeah, massive is the right word.
If you've been paying any attention to business news lately, you have probably seen the headlines regarding the bankruptcy of Saks Global.
Right, it's been everywhere.
And on the surface, that might just sound like another legacy retailer struggling to survive in the modern era. But there's a specific number buried in the reporting that changes the entire story.
A very specific number.
$700 million.
It's a staggering figure to visualize.
That is the jaw-dropping amount of luxury market share that is suddenly up for grabs because of this bankruptcy.
And the most interesting part is how it completely challenges the prevailing, almost accepted narrative that physical retail is dying.
Oh, absolutely.
Especially the physical luxury department store. People say it's dead and buried, but this number tells a different story.
Which brings us to the mission for our deep dive today. We are going to unpack exactly where that $700 million is flowing.
Right.
We're going to explore why a supposedly dying luxury department store sector is actually thriving for the players who actually understand the assignment.
Exactly. For the right players.
And perhaps most importantly, we're going to look at the brutal, real-world consequences of what happens when a company prioritizes financial engineering and real estate plays over the actual day-to-day customer experience.
It's a hard lesson. And to guide us through all of this, we're relying on a truly incisive, multi-part analysis published in Forbes.
It's a great piece.
It really is. It's titled, Where $700 Million Saks Global Left on the Table is Headed.
Right.
And the author of this breakdown is Lilian Raji. For those who might be new to her work, she is a global luxury communications advisor, a fractional CMO, and a columnist.
Let me just pause you right there just for the listeners who might not be deep into corporate titles.
Sure.
A fractional CMO, or Chief Marketing Officer, is basically an executive who works part-time or on a contract basis for multiple companies.
Right, a very strategic role.
Yeah, it allows brands to bring in top-tier, heavyweight marketing expertise without paying the massive full-time salary.
Precisely. And Lilian brings a massive amount of high-level perspective. She is the president of the Lilian Raji agency,
Right.
where for over 2 decades, she has served as a trusted strategic advisor for some of the world's leading luxury brands.
Wow, 2 decades.
Yeah. She's also the founder of the PR Advisor, which is a platform inspired by her decade-long National Jeweler magazine column.
Okay.
That platform offers communications and PR guidance, as well as training, for emerging to mid-sized brands.
That's incredibly relevant here.
It is. And her Forbes column, which is called The Pursuit of Luxury, is an absolute must-read because it examines how luxury brands use emotional marketing to capture their incredibly passionate customers.
Okay, let's get into the substance of Lilian's analysis because it paints a picture of a fascinating modern retail battlefield.
It really does.
It's not just a sad story about stores closing their doors. It's a story about a massive, aggressive transfer of wealth and customer loyalty.
Yeah, a vacuum.
Let's start by looking at that $700 million vacuum.
So the Forbes piece provides us with some hard numbers from a TD Cowen analyst. Saks Global has a portfolio of about 70 stores.
Okay.
And that physical footprint is contracting significantly as they navigate bankruptcy.
Right. They're closing doors.
Exactly. When you close those doors, the customers don't just stop buying luxury goods. That contraction creates a void worth an estimated $700 million.
So the immediate question is who is positioned to catch those dollars?
Right, and the data points to the retailers with the biggest existing customer overlap.
Who is at the top?
Nordstrom is sitting at the very top of that list with the 25% overlap. Bloomingdale's is right behind them at 22%, and Macy's is at 20%.
That is fascinating. I was looking at the performance numbers in the research right before the bankruptcy filing, and the contrast is just jarring.
Oh, completely.
You assume that if a giant like Saks is falling, the whole industry must be sinking, right?
You'd think so, yeah.
But it was a tale of two completely different trajectories. Lillian's analysis noted that Saks was dropping by double digits year over year.
By the end of Q2 2025.
Exactly. There was one month, I think it was June, where sales plummeted by 28%.
That is a free fall.
Right. So how is it possible that a sector is supposedly dying, yet Nordstrom and Bloomingdale's were growing by more than 10% at that exact same time?
It's a great question.
Bloomingdale's even posted a 13% gain that same month.
The why behind that performance gap is really the crux of the entire situation.
Break that down for us.
Well, the analysis highlights a brilliant conversation with Lindsay Namiacha, the CEO of Verify Skincare.
Okay.
She pointed out that from a pure consumer standpoint, Nordstrom is simply executing at a much higher level. She described a specific Nordstrom location in Los Angeles as the apple of retailing.
The apple of retailing, that phrase really sticks with you.
It's a strong visual.
Think about what that actually implies. When you walk into an Apple store, it's bright, it's buzzing with energy, the staff is incredibly knowledgeable, and the product is the hero. It feels aspirational.
That is the exact vibe she was describing at Nordstrom. It was bright, elevated, featured a great cafe, and offered a genuinely luxurious experience that made you want to actually linger.
Right, spend some time there.
Exactly. She contrasted that directly with her experience of Saks, where she admitted she couldn't even remember the last time she felt compelled to set foot in one.
And it isn't just about throwing a nice cafe into the middle of the floor or upgrading the lighting fixtures.
No, not at all.
The source material points out that Nordstrom already operates on that branded, better quality side of the retail spectrum. They aren't trying to completely reinvent themselves to capture this displaced Saks customer.
They're just doing what they do, but better.
Right. But the real differentiator, the secret sauce highlighted in the piece, is the leadership. It's about having executives who still operate with the mindset of actual merchants.
Yes. The text quotes a former senior vice president at Saks, Tom Ott.
Okay, what did he say?
He spent 24 years there, and he points out a detail that is incredibly revealing. He says that if you send Pete Nordstrom an email, he responds in about 10 minutes.
Are you serious?
Yes, and he does it in a respectful, engaged manner.
A 10-minute response time from a major retail executive. That sounds exhausting.
I know, right?
But it absolutely proves that customer and vendor obsession starts at the very top of the food chain, not just on the sales floor. You cannot fake that kind of engagement.
You really can't. That level of responsiveness trickles down to every single department.
It sets the tone.
Exactly. It shows a company that maintains a very tight feedback loop. They emphasize incredible service, they build genuine loyalty, and they make sure their digital operations and physical stores are actually talking to each other rather than competing.
So Nordstrom is clearly poised to take a massive slice of that $700 million.
Undoubtedly.
But we have to talk about the other major player in this money grab, Macy's Inc., which owns both Bloomingdale's and Bluemercury.
This is such a compelling part of Lilian's analysis.
It tells this incredible story about two completely different corporate boardrooms and what it truly means to protect the merchant's soul. We really should look at the rise of Tony Spring.
Let's do it. Tony Spring is the chairman and CEO of Macy's Inc., and his trajectory is fascinating. He previously ran Bloomingdale's.
Right.
As the research notes, Spring came into the top Macy's role and managed to completely change the momentum in just about a year. He took them from a state that industry insiders described as awful to posting positive, comparable sales.
Let me quickly define comparable sales, or comps, for anyone listening who might be outside the financial sector.
Good idea.
If a retailer opens 50 new stores, their overall sales will obviously go up. But that doesn't mean the core business is healthy.
It just means it's bigger.
Exactly. Comparable sales measure the revenue of stores that have been open for at least a year. It tells you if the core business is actually growing and attracting more customers to those same locations.
That is a crucial distinction. Spring established a real growth proposition by focusing on comparable sales. He launched a bold new chapter strategy.
Now, what did that entail?
This meant prioritizing the revitalization of 150 core Macy's locations while simultaneously continuing to pour investments into Bloomingdale's and Bluemercury, which were already performing well.
So he acted like a true merchant.
Yes, trying to sell great products to happy customers.
But doing that requires money and patience, and his leadership, along with the discipline of the entire Macy's board, was severely put to the test.
This is where the drama really starts.
Right. In late 2023 and early 2024, the vultures started circling. Macy's faced a massive corporate battle.
Real estate investors.
Yep. Arkhouse Management and Brigade Capital came in and made a series of escalating bids to take Macy's private. The numbers were huge. They started at around $5.8 billion and eventually climbed up to nearly $6.9 billion.
And this is a classic and, frankly, often tragic maneuver in the modern retail sector.
Walk us through it.
Arkhouse is fundamentally a real estate-focused investor. When industry analysts look at the structure of these bids, they saw exactly what the true play was.
It wasn't about retail.
Not at all. It was not about turning around a retail brand. It was an aggressive play to monetize Macy's massive property portfolio.
Which is huge.
Oh, massive. Some estimates value it between $5 and $9 billion on its own.
This right here is the critical aha moment in the analysis. For you listening, if you're trying to understand why so many of our favorite stores have seemingly collapsed overnight, you have to understand this mechanism.
It's the real estate versus retail battle.
These investors did not care about selling luxury handbags or improving the fitting rooms or being great merchants. They wanted the magnificent buildings sitting on prime real estate.
Exactly.
The financing structure they proposed relied heavily on what is called asset-based lending, tied directly to Macy's own real estate.
To put that into everyday terms, asset-based lending in this specific context is essentially like a corporate raider wanting to buy your house, but they don't use their own money.
Wait, how does that work?
Instead, they take out a massive mortgage on your house, use that cash to buy the house from you, and then they leave you living there.
But now you have the debt.
Right. Now you are the one forced to pay off that massive new mortgage while you are just trying to run your small home business.
It is wild that this is a legal and common practice. The business is suddenly drowning in debt it didn't ask for, just so the new owners could buy it.
It completely drains the company of its resources. The Forbes piece highlights that this is the exact same asset-stripping playbook that led to the slow, painful deterioration of Sears under Eddie Lampert.
Ah, the Sears comparison. That makes total sense.
You extract the underlying value from the physical real estate assets, and you leave the actual retail business saddled with so much debt that they can't afford to fix a broken escalator.
Let alone buy new inventory or hire great staff.
Exactly. And highly relevant to our main topic, Lilian points out it's essentially the same financial engineering strategy that Richard Baker applied to Hudson's Bay Company and Saks Fifth Avenue.
That's the link. But the Macy's board saw through it.
They did.
They opened their books to the investors. They provided detailed store-by-store profits and losses to prove the retail business was viable. But when they saw the conditional, unsigned financing drafts that relied heavily on stripping their own real estate assets, they drew a hard line.
A very firm line.
They rejected every single offer. They locked their doors against investors who simply did not understand or care about the luxury consumer.
And the market rewarded that incredible discipline.
The numbers don't lie.
Because they didn't sell out the merchant's soul to become a real estate piggy bank, the results by late 2025 were undeniable. Macy's stock was up more than 30% year-to-date.
Incredible.
And Bloomingdale's reported an 8.6% increase in net sales for the third quarter, which marked its fifth consecutive quarter of comparable sales growth and its strongest performance in 13 quarters.
So Macy's survives and thrives by fiercely protecting their relationship with the customer and their financial independence. But what happens when a retailer does the exact opposite? That takes us behind the curtain of the Saks collapse, and the analysis of their internal operations is just shocking. We have to talk about the weaponization of chargebacks.
This is one of the most revealing operational failures detailed in the piece.
What exactly is a chargeback?
Well, for context, in the retail industry, a chargeback is essentially a fee or a fine that a department store slaps on a vendor for violating a rule in their shipping manual.
Right, like if a brand ships 1,000 cashmere sweaters, but a warehouse manager decides the barcode sticker is a half-inch too far to the left on the box, or the tissue paper is the wrong color.
Exactly. Historically, it's an occasional nuisance fee to ensure suppliers comply with warehouse automation.
Just a cost of doing business.
Right. But according to Lillian's analysis, inside Saks, this frayed the financial relationship entirely. These chargebacks morphed from a mechanism of basic compliance into a heavily relied upon structured revenue stream.
Wait, they were planning on these fines?
The corporation was actually relying on finding their own brand partners just to make their margins look better on paper.
Let me make sure I'm wrapping my head around the reality of this. Think about a small, independent luxury brand. Saks approaches them and demands a massive discount on the wholesale price, say 60% off retail. The brand agrees for the prestige of being in Saks.
Because it's Saks Fifth Avenue.
Right. But then, on top of that thin margin, Saks layers on these arbitrary, relentless chargeback fees. The vendors were literally making zero money or actively losing money just for the privilege of selling their products at Saks.
And the result of treating your partners that way is entirely predictable. It destroys trust overnight.
Of course it does.
Vendors realize they are being squeezed, so they start pulling back. They send less inventory. They save their best exclusive pieces for Nordstrom or their own boutiques.
And that corporate tension translates directly to the physical sales floor.
You get thinner assortments, out-of-stock sizes, and painfully slow deliveries. The magic of discovery and abundance that defines luxury retail just vanishes.
And the physical decay of the stores perfectly match that internal operational decay. The piece includes a striking quote from a former style advisor at Saks in Chicago, John McBaron.
What did he say?
He described working in a shabby-looking store. Have you ever walked into a once great department store and it just feels sad?
Oh, absolutely. It's depressing.
The lighting is bad, the fixtures are scuffed, the carpets are stained, and the salespeople look demoralized.
Yeah, you can feel the energy is gone.
McBaron said it got to the point where the store looked so visibly neglected that customers were actively coming up to the staff and asking if they were going out of business.
That is brutal.
The stores were starved of capital because of the corporate debt structure above them.
Now, to be fair to the current situation, there is an ongoing attempt at a comeback. Jeffrey Van Romdonk has returned as the Saks Global CEO.
Right, he's back.
It's worth noting that he is the former Neiman Marcus Group CEO, right before the Saks and Neiman merger, and he actually led the previous bankruptcies.
That is a track record that certainly raises eyebrows among retail analysts.
Definitely. But he recently released a statement outlining their recovery plan.
He is definitely throwing out some massive numbers to reassure the market. He claims they have secured a $1.75 billion financing package.
That's a lot of money.
He says they have agreements in place with leading luxury conglomerates, that nearly 400 brands have resumed shipping products, and that inventory receipts are up 30% over the prior year.
But the core insight from Lilian's analysis here isn't really about the inventory data.
What is it about?
It's the reality that you can use $1 billion to buy back inventory and fill the shelves, but you cannot easily buy back consumer trust.
That is such a crucial point.
If your core luxury customer has already shifted their daily habits and their loyalty to a thriving Nordstrom or a Bloomingdale's over the last 2 years, just having sweaters back on a rack won't magically bring them back through the doors.
Which leads us to the most forward-looking part of this deep dive. What actually happens next?
This is where it gets really strategic.
The analysis doesn't just diagnose the illness, it provides a framework for the future. It outlines 3 plausible futures for Saks Global. Let's walk through them because they offer a masterclass in business strategy.
The first scenario outlined is a cosmetic restructuring.
Okay.
This is the path of least resistance and, frankly, the most pessimistic outcome. It is a purely financial reorganization that addresses the debt on spreadsheets, but changes absolutely nothing about the fundamental way the business operates.
So business as usual, just with new math?
Basically, they use that $1.75 billion to emerge from bankruptcy a little leaner. They close 20 or more underperforming stores. They shutter most of the Saks off fifth discount locations, and the executives declare a hollow victory.
But the analysis points out the fatal flaw here. You have just saddled the company with a massive amount of brand new debt.
Right.
And you have the exact same leadership team in place that oversaw the decline. This path is widely viewed as a slow, agonizing Sears-style fade.
You're just kicking the can down the road and delaying the inevitable collapse.
So let's move to future 2, which is called radical simplification.
This scenario is deeply rooted in that merchant mentality we keep coming back to.
The merchant's soul.
Yes. It relies on clearly segmenting the brands so they don't cannibalize each other. You position Saks Fifth Avenue strictly as opening price point luxury.
And just to clarify for everyone listening, opening price point luxury means the entry-level tier of the luxury market.
Right, the accessible luxury.
We are talking about the aspirational shopper buying a designer fragrance, a premium wallet, or a pair of shoes, rather than the customer dropping $15,000 on a couture gown.
Exactly right. So Saks handles that massive aspirational tier. Then Neiman Marcus sits one step up, competing directly with the pure luxury players.
Okay, that makes sense.
And finally, Bergdorf Goodman remains the absolute pinnacle, the untouchable top tier of the market.
Wow.
Crucially, in this scenario, you reserve a massive 30% of your budget, specifically for new, emerging brands to create a genuine, thrilling reason for customers to come in and discover something they haven't seen on Instagram 100 times.
I think that makes so much sense. It gives each banner a distinct, undeniable identity.
It clears up the confusion.
And Lillian's analysis adds some brilliant strategic advice to this scenario regarding the discount side of the business.
About Saks off Fifth.
Yes. The advice is do not close Saks off Fifth. Instead, let it fight a street war directly with TJX companies like TJ Maxx.
Oh, that's bold.
Right. TJX has completely mastered the off-price business for luxury wear shoppers. Saks off Fifth should be unapologetically serving the discount-motivated shopper who wants the sloppy second.
A sloppy second.
The overstock that the main Saks customer already passed on. Let them own that lane entirely.
There's also a vital recommendation in this scenario about e-commerce.
What's that?
The argument is that Saks needs to stop forcing its website to compete with its physical stores for the same sales.
Oh, that internal competition.
It's toxic. Keep the physical stores as magnificent destinations for tradition, where customers happily lose an afternoon browsing, touching the fabrics, and interacting with expert staff.
And the website.
Use the e-commerce platform as a broad digital marketplace for discovery. Let untested luxury brands prove they have real sales traction online before you dedicate precious, expensive physical floor space to them.
Let the digital and the physical complement each other rather than fighting over the same commission.
Exactly.
Okay, so that is radical simplification. But then there is future 3, which is the breakup. And this is where the Wall Street rumors really start flying.
Oh yeah, the gossip mill is turning here.
Tell us about it.
The reality is that the most valuable, pristine asset in the entire Saks global portfolio isn't Saks itself, it is Bergdorf Goodman.
The crown jewel.
Restructuring experts note that Bergdorf makes infinitely more sense as a standalone, hyper-luxury entity than it does serving as a hostage to a debt-laden parent company.
Right.
Saks Global has already reportedly explored selling a minority stake in Bergdorf at a valuation sitting somewhere between $1.5 and $2 billion.
And the research drops a fascinating open secret here. The massive global luxury conglomerates, specifically LVMH, run by Bernard Arnault, have long-eyed Bergdorf Goodman as the ultimate U.S. foothold.
They already bought Tiffany & Co.
Exactly. Imagine a powerhouse like LVMH taking over Bergdorf and rebuilding it with a pure, long-term luxury mindset, entirely free from the desperation of short-term, debt-driven transactional retail.
It would be unstoppable. Another fascinating, albeit radical idea proposed by an attorney commenting on the situation was to spin off the iconic flagship locations of Saks, Neiman's, and Bergdorf as employee-owned co-ops.
Employee-owned co-ops, that is radical for this space.
It is, while keeping the national corporate operations separate. It speaks to the deep desire to preserve these institutions of American retail culture, which collectively represent over 340 years of history from being destroyed by private equity.
So let's bring this all back to you, listening right now. Why does any of this matter if you aren't an executive at a luxury brand?
It matters a lot.
Whether you are running your own small business, managing a team in a corporate environment, or just an observant consumer watching where your paycheck goes, there is a profound universal lesson here.
Absolutely.
The narrative that the death of the luxury department store is inevitable is just a myth. It is an excuse used by bad management to justify their failures.
The data firmly supports that. 83% of all retail sales are still conducted within 4 physical walls.
People still want to go to stores.
The throne of physical retail hasn't disappeared. Customers still desperately want that physical experience. They want elevated service, human connection, and the magic of discovery.
So what is actually dying?
What is dying, and what honestly deserves to die, is the disconnected, financially engineered, spreadsheet-driven retailer that Saks Global allowed itself to become.
The ultimate takeaway from this entire saga is that you cannot sacrifice your core value, what we have been calling the merchant's soul.
Right.
You can't trade that for short-term financial engineering or a clever real estate play if you forget why the customer actually walks through your doors in the first place, or if you start treating your partners like piggy banks. No amount of debt restructuring or PR spin will save you.
It just won't work. And if you found the mechanics of this corporate battle as fascinating as we did, there is so much more to uncover.
Where can they go?
We strongly urge you to go directly to Forbes to read the full, multi-part article. It is packed with even more granular insights, executive interviews, and deep strategic analysis.
Highly recommend it.
You should also go to her website at www.lilianraji.com to read more of her additional analysis on the luxury industry. Connect with her on LinkedIn and follow her on Instagram and YouTube for ongoing brilliant commentary on the business of luxury.
We highly recommend checking out Lillian's work. It really changes how you look at the stores you walk into every day.
It really does.
To wrap us up, I want to leave you with a final provocative thought to mull over. We have spent all this time talking about how traditional legacy department stores are being punished for treating retail like a massive real estate portfolio instead of a customer experience.
Right.
But zoom out and look at the wider landscape. We have an entire generation of digital-first luxury brands that were born on Instagram or TikTok.
The digital natives.
Right. They have zero physical real estate footprint. And right now, they are hitting a massive wall with digital customer acquisition costs. Online ads are just too expensive.
They're getting priced out of the internet.
Exactly. So what happens when those digital natives try to step in and fill the void left in those magnificent empty buildings on Fifth Avenue?
That is a fascinating question.
Can a brand born entirely on the internet learn to master the physical merchant's soul? Or will the legacy giants who survived the real estate wars, like Nordstrom and Bloomingdale's, completely reclaim the throne before the digital brands even figure out how to run a fitting room?
It is going to be incredibly fascinating to watch.
Thanks for joining us on this deep dive.